Hello, everyone. My name is Dave Miles. We're going to kind of get going here. We're going to get going on the slow part of things. I want to welcome you here this afternoon. I'm in beautiful downtown Geneva. That's Geneva, Nebraska. If you can imagine a cornfield and then take another cornfield and stack them up for 20 miles all around you, and then put a small town of like 500 houses in the middle of those cornfields. That's where I'm at. I'm kind of in the middle of the nowhere. It's nice though, because it's the middle of nowhere. The population here is population 2,236. And so that's where I'm coming to you from today. A couple things. My name is Dave Miles. I've worked at ValuSource for the last 20 years. I take a lot of phone calls and help a lot of practitioners get done what they want to do. If there's something that you want to take a note on today, it's going to be my email address over here. It's dmiles@valusource.com. Hopefully that's in some of your contact books. And you know that I like to talk about this stuff. So feel free to reach out to me and go from there. I also like it when people ask questions during the presentation. And if you have any questions, you can type them in the Q&A panel, or you can put them over in the chat log. Now, unfortunately, today I'm also the moderator as well as the presenter today, so I get to do all things. And so that's going to create a couple of little technology glitches, but hopefully you can ask your questions in the Q&A panel. Hopefully this can open up into a bigger discussion. Hopefully we can have a great time talking about all of this stuff. The market approach and keyvaluedata.com are two things that in the valuation world were very necessary, and knowing about them and understanding them at a deeper level. I will say that I presented all of this more for an intermediate level, not necessarily a basic level. And so if I skip over some things that are pretty basic, I apologize. If you don't get those, feel free to reach back to me. We'll try to fix that. And certainly we can also go forward. Now I got a hand raised here. I'm trying to figure out what that is. I apologize. I'm glad the hand got raised. Where the hell do I go to? I'm guessing that it's just an item. So like, you're clicking up your hands and you're saying, okay. And that's good. If it's supposed to be something more than that, then feel free to send me something in the Q&A or chat panel, and I'll be happy to look at that. So as I said, let's go ahead and get started on the slow basis, and we'll kind of go from there. So let's talk a little bit about some background information. One of the biggest myths I think out there is a computer app can tell you the value of a business. I know, strange coming from the guy who produces the software and publishes the software, but a computer app, in my opinion, simply is a tool for technology. And the valuation analyst should look at the facts and circumstances in a specific case and opine on a value based off of that. And I should tell you two things here. One is I think the AICPA hates the word opine. I am a CPA, so I understand that in the world of audit, opinion has a big meaning, and trying to cross that over into the valuation world is something that they tend not to. But let's face it, a valuation is an opinion of value. It's saying, here's what I think the future is going to hold as far as cash flows and risk. And as you bring that back to today's value, that's your opinion of that. What's interesting is that you don't have to be a valuation expert to have an opinion of value of your business. I know there's a lot of business brokers out there that would, really enjoy discussing this over a drink and saying, oh yeah, all that sweat equity, that sure increases the value of those companies. The other thing is that, well, I'll get to it in a minute. I think we have some more myths coming up. Here's a myth for you. The income method is the most used method to value a business. Now, this is my opinion. I don't think that's true at all. In fact, I think the reality is that most business valuations are done for planning purposes, insurance purposes, planning purposes, strategic decisions, which direction do we need to go? And most of the value of a company is built up in the head of the owner of the company, or the the leader of the company. And I believe that they're using the market approach to come up with those values. They've been looking out on the internet, and they've been seeing people, and they say, oh, I'm worth 10 times. And I have a question over here saying, will there be pop-ups to track the CPE? And the answer is absolutely. There are pop-ups to track the continuing education. Since you brought up the continuing education, I'll say this, that you must answer the polling questions that are out there, and you will have your continuing education certificate through the portal at NACVA, and you can get that there. And I believe that today's webinar is 2 hours long, and as a result, you get 2 hours of CPE. Anyway, I'm also trying to say that most values are good enough in the cases where they're using a business value. Where valuation experts get called in is in adversarial positions. And in adversarial positions, we must have a little bit more than just, oh, I think it's going to be this. We need to actually start to defend why we think our value is. So somebody's saying, I'm seeing bankruptcy and divorce as a leading request for valuations. I did not know that I put that in there. I believe that bankruptcy and divorce are the biggest adversarial positions for valuation work. And that valuation work in an adversarial position is where we kind of lay in our bailiwick. Here's where we throw our hat. But I'm trying to make the point that most business owners have an idea of what the value of their company is, and to increase the value of their company, they need to do this. And if they're trying to insure themselves, they're going to say, "Oh, the company's worth this value here." And a lot of it is the confidence in that particular value is probably low. I don't really know what it is. The confidence in an expert's opinion of value is probably very high. And I'm just trying to make the point that says that most valuation experts will use the income method for reasons I'll discuss later, but I think that most valuation work is not done with all of the expertise that we have, and that it's based more off of a market approach than anything else. Valuation is one marketplace. I think that, as I said before, that IRS and SBA lending has created a downward pressure on valuation fees. I'm getting a chat box here. Let me see if I can bring it up. And the chat panel says, I concur that the market approach is more utilized for most purposes, especially for sale purposes. However, the IRS and court purposes, usually the income approach is more utilized. Totally concur. That's the point I'm trying to make, is that saying, okay, keep in mind that when we're out there applying our trade, and what we're really trying to accomplish here is that we're doing something slightly different than most people are doing. And so when we try to get into the market approach, I'm going to try to make some distinctions and try to draw some lines and say, okay, how would most people perceive this, and how should a valuation professional perceive this, is where I'm going at. And in this particular slide here, I'm just trying to say that I think that the codification of the standards and the purposes of our evaluation work has created kind of a dichotomy evaluation. Experts who start with the blank slate for every engagement versus a formula or template engagements. So I know a lot of practitioners out there that are in the SBA 7A area, and what they'll do is they'll tend to create these templates, and they'll put something together. It only takes them 3 or 4 days to do evaluation. It's a grinding job to do because they put a lot of work into it for a very low fee. I know people out there that'll charge $500 an hour. They start with a blank spreadsheet every single engagement, and people are paying them for their expertise and the ability to explain what it is they did. And that's kind of the dichotomy I see happening in our world. The only reason I share that with you is because I talk to hundreds of people every year, and that was my perspective on it. Something that I've been fighting for 20 years is, if I use software, my expertise is subrogated. And if I use software, I cannot express my own opinion. And I have a hard time with this particular myth because I tend to think that software is really a tool. We all use software in producing a value of a business. And whether that's Microsoft Word or Microsoft Excel, it's rare when we get out our calculators. Something that I always thought was interesting is the history of stuff. And so when we go back to the Gordon growth model and we take a look at that, in 1959, the Gordon growth model was invented. We did not even have calculators at that point, did not send somebody to the moon. And so today we have all of these software tools available to us. We can do a DCF model, a substantial DCF model in a few minutes, let alone. And so looking at that particular Gordon growth model in the past, controlling that Gordon growth model of the past was a really great solution, because we could go in there and say, oh, here's a particular formula, plug in our little assumptions, and we can come up with a value. And so things have changed over the last 50, 60 years. And I think over the last 10 or 15 years, we really are trying to, what do I want to say, plateau a particular thing. We're growing into a mature business here. I got something on the chat panel. Friend of mine, Ron Rudick out there, says, we valuators control the art of the conclusion. Very good point. Okay, we're done with the webinar. I think you know, that's probably going to be where we end up at. And another person out here on the chat panel is saying software is only dangerous if there's a black box element. We have to define black box, in my opinion, but I agree with you. When you can't see what's going on, or you can't calculate around that particular black box, that's when you get into a really bad problem. I know at ValuSource, one of the things I've tried to do for the last 20 years is saying we need to be very transparent. We need to use spreadsheets that you can see the entire formula, and you can go out there and calculate around it. But anyway, I've been fighting this particular problem for a long time, and so I just wanted to bring it up. And one of the other things is bad work is bad work. And so if we have people in our profession out there that are producing bad work, we need to make sure that we clamp down on that. I think that if someone is a bad communicator, because it's just a metaphor, that was what my note was all about. So here's the last one is I can't learn valuation from the guy who sells the data. And what that means is that I have skin in this game. In other words, if you buy subscription at keyvaluedata.com or valuesource.com, you know, I get to put my kids through college. So I do have skin in this game. However, I do think that for having done this for 20 years, I probably know more about the databases and how they're put together than probably most other people in the world out there. I'm not trying to ring my own bell here. I'm just trying to say, you know, I've learned an awful lot in the 20 years about what goes into those databases and what some of the tips are and what some of the traps are. And hopefully that's what I'm trying to share with you today. The most important thing for you to realize is that these are my opinions. And obviously I've been wrong a lot. I mean, hell, I was telling somebody that I didn't think that a you know, right of first refusal would affect the marketability discount. I was so wrong with that. You know, it's like, okay, if you have a right of first refusal, what it means is everybody has to go through all of this work, and then somebody can yank the deal out from underneath you. Of course, that's going to create a problem with making the deal. And so I was totally wrong with that. So even today, I get wrong things, and I just want you to know that some of the things I might say today, they may be totally wrong. But the best part is that you're the expert. You get to decide how to do things. And the most important thing that I want to say with that is not only you get to do things the way you want to do them and have done them, but you should understand why you're doing them. And maybe today we'll get some of the logic behind those decisions that you've been making in the past actually work. And you can go out there and see better things. Anyway, my opinions, I have skin in the game, so I have a bias in all of this. And hopefully you can tell the reasons why I'm doing something and take that reason and say, should it make sense to me? And if it does, use it. If it does not make sense, don't use it to me. So here is the first polling question. If I can bring it up, launch the polling. And I am not sure what that means. So here in this polling question, I'm asking, are you responsible for your own opinion? Gosh, do you think anybody out there is going to have any disregard for this? I bet 100% of the people say yes, because that's just how the question was set up. What a nice guy I am, right? Just go out there and set you up. And now as I go through and go to the next polling question, and let's see, I'll hold it open here for about 4 or 5 more seconds. And as I do that, I want to say I really appreciate the chat. And please keep that up. That makes this an interactive process. I'm not sure how people put their hands up, but that was really cool too. I'll probably ask a few questions for people to put their hands up. So 100%, okay. Didn't know that I could get a poll that launched 100%, huh? And so I think I have to close this poll and launch the next poll. And this here is really, there we go. Cool. And so now I have the second poll in progress. As I said before, this is really the important part of today's lesson. In other words, as I talk about these different things and as I try to input my opinion and say, here's what I've heard, here's how I thought about it, and here's how I've come up with things, you are more than welcome to disagree with me. In fact, I encourage that because that's what makes us better practitioners. But you are responsible for the logic behind your own opinion. And it's also that ability to communicate that logic inside of your reports that's going to make you a good valuation professional. I should also say that if this isn't working for you, feel free to drop off. Hopefully I don't want to waste your time. You're not going to hurt my feelings if you drop off of the webinar. I should also say that I tried to throw this together in a relatively fast manner. And so if I get a little bit out of sorts, that's the reason why. And I apologize to you for that. Again, 100% of the people say you are responsible for all of this. And so I just wanted to make sure that that was very clear, that the opinions today are my own opinions. So let's talk about the asset approach. There are 3 approaches to valuation. Before we get into the market approach, I want to talk about the other ones. There's an asset approach. It is called build or create. What does it cost somebody, a hypothetical buyer, to build or create that business? They have to go out and they have to say, okay, do I need to buy furniture, fixtures? Do I need to rent a place? And real estate and buildings are usually excluded from the value. And the idea behind that is that if we exclude those things, and in the market approach, you need to take a look at that because it's a huge difference between Guideline Public Companies and small businesses. And that is that the buildings and real estate are excluded in the smaller companies. And the reason is that if you bought that business, could you pick it up and move it somewhere else? What I always thought was an interesting concept were the hotels. And so you have a hotel or motel. I come from Colorado, so I'm going to use some examples from Colorado. But if I go up to Cripple Creek, and this is a small gambling town, supposed to represent all the cowboys of yesteryear in the gold mining days. And you had a hotel in that particular location, is that different than having a hotel that's 20 miles down the road in, say, Woodland Park? And the answer is yes. So location and geography make a huge difference there. And that real estate is an important part of the business. And so that creates some issues when you value hotels, motels, and those kinds of things. But the idea is that you can pull the real estate and the buildings out of most valuation work, and it's out there. The idea of building your own business also include the idea of accounting-based assets. And so, I know in our software, we deal with just the accounting-based assets, but there are a lot of other assets that are in place. Let's say that workforce in place. What does it charge? What would be the cost to get a workforce in place that could build this particular product? So today I want to talk about another Colorado company. We talk about the Grammys that come up, and those little trophies are made in Colorado. And so I was thinking, what about a little business that does trophy work or does some metal manufacturing? And how would I go about searching my databases to come up with the value inside of those? And so, what I want to get after here is that, what are the assets involved? So if I have 2 or 3 people that run those machines, what do I have to make sure? And the Grammy Awards are done by one person, but if I had a machine shop and I had 2 or 3 people building those machines, would I need to hire an office manager? Would I need to hire a marketer? How do I build that workforce in place? And how do I create those policies? Those are economic assets that are not accounted for in an accounting process. CPAs are great at tracking costs incurred. We're not so great at figuring out, what is the difference between cost incurred and what's the value of what it's really worth. And so a lot of times when we do an asset approach, we just take the assets on the balance sheet and we say, okay, what's the market value? I have accounts receivable. Okay, I could factor those out at 50%, no problem. I have some, we don't include the real estate, so we won't put that on there. I might have some other assets that I could dispose of at, at a deep discount. That's a liquidation value in my mind. And I think that other economic assets that need to be put in place, you need to take a look at those. And so I have a polling question here. I can launch it, polling number 3. And so what I want to talk about is saying, when you look at your asset methods, what really are you doing in your work? Are you using an accounting basis, a liquidation basis, and you're saying that's my low value? Or are you saying, hey, here's what the assets in place are worth? That would include workforce in place, some other intangibles that might be in place. And Do you do both methods? Do you say, okay, here's the cost to build this business and here's the other one? As I said before, this tends to establish the lowest value of the business. It doesn't tend to say, okay, what's the highest and best use of these items? But it really is a build or buy decision. And that's interesting. And so I'm going to go ahead and close out of this poll here in a second. And the only reason I talk about the asset approach in contrast to the market approach is that I want to make sure that, as we track our decision tree down into, and one of the items on our list is to develop a decision tree. I want to make it very clear. I don't have a decision tree to pass out to you. Your decision tree is your procedures that you use to develop a value. And depending on the type of engagement, the purpose of the engagement, the standards of values, those procedures may or may not change. But as you put into those procedures, you need to ask yourself, what approaches am I looking at here? And why would I use the market approach over this asset approach? That's where I'm going with this particular item. The income approach is all about taking future cash flow that's due to a security and discounted at an appropriate risk for achieving that cash flows. And I believe that most valuation or experts, somebody else out there, I think Kent was out there and said, hey, this is the approach most used by business valuation experts. And I'll tell you the reason why I believe that's the most useful approach for business valuators. I got another thing here, and somebody says, I use the asset cost approach as my floor, and then the income approach, and then I use the market approach to establish the value overall. Whole bunch of concepts come out of that comment. That was Kent again, and the concepts are reconciliation of values. I agree with you. I think the asset cost approach is kind of standalone on its own, and it's a smallish value, a floor value, if you will, because it doesn't take into account the highest and best use of the assets. But the other two, I think, and that's kind of what I want to talk about in here, the other two, as you start to synthesize or you reconcile those two approaches together, depending on whatever method you use, you start to get a better feel for the value of the company. But the income approach allows you to discount future cash flows. I get to predict, I get to say what the future cash flows are, and as I look at those particular items, cool. So I have somebody that raised their hand here, Michael Fleming. I'm going to press allow to talk, and we'll see what happens. So you are unmuted, but you're muted on your side. So I am going to take you off right now. We have another person out there, George Hawkins, who said, tell me more. I'm going to unmute him. And I'm probably not doing a very good job of this. I apologize, guys. You might have wanted to say something. I'm going to get better at the Zoom stuff, but wow, what an incredible thing. So, okay. So let me dish that. So I'm going to predict the cash flows of this company. It is directly related to this company and its ability to generate cash flows. It is a direct connection. And I think that inside of your logic, you need to say directly connected. That's why I like this. The risk is directly connected to this particular item. As an expert, I love that because now I can say, look, I don't need a proxy. I don't need some sort of substitute and I'm going to adjust and manipulate that substitute. I am directly dealing with this particular company and I can say what the value of that particular item is. We all have heard Chris Mercer say, if you take the cash flow and you discount it at an appropriate rate, you come up to the value. Got a couple of questions here. Somebody says, why would you use a liquidation approach when determining an asset value in a going concern company? And the answer is what do you do when the cash flows generated are less than the value of the liquidation of the assets? And so that creates a problem for you. And so you get a highest and best use problem out there. So what I would suggest to you is that you look at the idea of an ESOP. A lot of times ESOPs are kept in a maintenance mode, in a mode that goes on and on, even though if they had sold the assets in that maintenance, they would have more value than continuing to operate. And so when the cash flows are less than what I want to say, the economic asset value, or when the assets are worth more than that, you have to ask yourself, what value do I need to look at? People don't buy assets just to buy assets. They buy them to produce earnings. The assets are just a means to an end. Yes, the question is what's that end? And we'll talk about that when we talk about public companies coming up here, at least I hope to. Okay, so where am I at? Oh, I've done something bad here. I've opened up a couple of people on the show, and there we go. Hold on a second. There we go. Okay. The disadvantage of the income approach is that we're talking about the future. We all put on our fortune teller hats, and we go out there and we say, oh, I know what the future cash flows of this company are going to be. In Colorado, we have a family law case where you're not supposed to use data from beyond the date of divorce. And so if you try to use a DCF model, it's usually looked down upon and grinned. A lot of my colleagues back there will have debates over whether we can use a DCF in family law or not. And a lot of people just say it's not worth it. I'm going to use a capitalization of earnings model and call it done. But no matter what we're dealing with, a COE model or DCF model, we are predicting the future. And we are predicting that future off of the history of the past and saying it's most likely that this occurs. And there's a whole bunch of stuff we can talk to on the income approach about expected value and probable value and all of that. But we are at the bottom line of all of this predicting the future. And so the question I would ask is who, when doing a 2018, would have predicted a pandemic that shut down the world? That's on the crazy side. Nobody would have said, oh, that's part of my expectation of cash flows and the value part of that. So I got a couple of people on the chat panel here. Let's see. Somebody says, yes, reconciliation of values is important, and I often ignore the cost approach value if it's dramatically different in what it yields over the other values. Concur. I think everybody else in the group would concur with that. Joshua out there says, it's not that we know what the future holds, it's that we can have the same view of the future as a hypothetical buyer. And that's a big statement. That's a big statement there, right? The hypothetical buyer, the hypothetical seller, and can we both agree on what we think the future is going to be like? If we can, then we can come up with the value. And that's truly what's going on there. In fact, one of the big conversations I have with a lot of people is that, hey, is the real value and our opined value the same thing? And it's very interesting to see that in the world. I think of all the people that have been around, I'm talking about people who've been in this business 20, 30 years, you know what I mean? One person said we had a business that was sold 6 months afterwards, and we could compare it to that particular opinion of value. I don't know what the outcome was, but one time out of all of that. Ron out there says we are not predicting the future. We are asking the involvement of management to provide a forecast, which we will inure a cash flow for value. Again, everybody's entitled to their own opinion. I believe that when we use a capitalization of earning model or a discounted cash flow model, that formula, the mathematics of it says, I am taking the cash flows in period 1 and period 2 and period 3 and discounting them back to today's value. That is a prediction of the future. It's implicit in the mathematical statement. That's the logic that I use that. And if you want to say, well, I didn't do it, management gave me those predictions. Okay, so you agreed with them and you used it in your calculations. So at some point, there is at least an implicit agreement with that prediction of the future. And Joshua says there are expected values, not predictions. Don't want to talk about the income method today, but give me an email, Joshua. I'd love to talk to you. Let's see, moving on here. So the problem with the income method is that it's a prediction of the future. I would also say that the income method is the least likely to be understood by lay folks. In other words, if I have a person who has a truck company and they spray the truck beds of items in Pueblo, Colorado, you know what I mean? Trying to understand the present value of a discounted cash flow is going to be very difficult to get across to that gentleman. However, if I use a market method, I can say, here's what other companies are selling for in your realm. This is what you should expect to get based on your size. And that brings us up to the market approach. The advantage of the market approach is that it is evidence, empirical evidence of saying what buyers are willing to pay in the past, the recent past or some past, about this particular company. And as we look at those recent past and we say, here's what they paid for, wow, it's pretty hard to deny that. The problem with the market method is that it's very, very difficult to find a comparable business. And we usually end up making adjustments. We usually try to come up with different components of a business and say what those are. And that's really what we want to get into today is say, okay, as we look at these different components and as we look at these different items, are we able to look at that? I have a comment here. It's important to not harden one's view of which method or methods to choose or ignore. That is, or for example, the market can become irrational and give a far higher value than irrational, but that's the market. Similarly, the market value can be irrationally negative in priced assets well below the asset value. The market is what the market is. The market is what the market is. And we think that the rational value is another method is really the only theoretical one when the real world sees otherwise. Okay, off the top of my head, I'm an introvert and I like to take these things and really think them over for a day or two, but off of the top of my head, I agree with this in some respects and I disagree with it in some respects. So basically, you know, we had the market sell-off here the first quarter of 2020 due to you know, people closing the world down. And is that a fire sale or is that what the market really is expecting? I think about people like Warren Buffett. As I said, I'm in Nebraska. He's over in Omaha, a couple-hour drive away. And Warren Buffett is a growth investor saying, you know, I want to buy things for the theoretical value, not necessarily their market value. And then we look at the definitions that we're looking at. Is this fair market value? What a willing buyer and a willing seller would trade for, having full knowledge of the facts? Now all of a sudden we get into something else. Right now, our problem is that a willing buyer and a willing seller don't have full knowledge of the facts. All they have are unexplained facts, and that creates a whole bunch of issues for us. Again, my opinion, you know, you're welcome to look at that, but that's where the whole COVID-19 process comes into our thinking as well. You know, so we're going to talk about how does the COVID-19, the shutdown of the world, affect some of these market values, and how would you make adjustments to them? Again, every valuation is unique. It has its own fact pattern, its own circumstances. And as it does its own circumstances, you have to make your own adjustments and create your own expertise and report it accordingly. And so I'm not trying to get into that part of it. I'm just trying to say what kinds of things do you need to think about when you're doing that. So let's talk about comparisons. Usually businesses are compared as to product size and geography. And you know, I think if we look at the literature and we go out there and we read all of the books, I think that that's pretty much the way we tend to look at this. Let's see, I have a comment here that says, even in using the income approach, utilizing the market approach value, even if there isn't enough data or if it isn't bulletproof statistically, can give a benchmark value. I use that data to bolster my income approach opinion of value. I believe that's how most people use the market approach, is exactly what you just said. So, but back to the presentation here, product or service, size, and geography. And it's very difficult to compare the competitive advantages of one business to another business, even if both sell the same product, are the same size, and operate in the same geographic area. And that's really what the problem with the market method is all about. What's that comparison? How do we make that comparison? What are the disadvantages of the way we make that comparison? So here's my example that I want to throw out there. A pizza shop. Like I said, I did live in Pueblo, Colorado. We have the north side and south side. South side was a steel mill. Steel mill's been there since 1870 something or another, and they have a pizza shop down there. As the mills and the steel went over to China and to other areas, that part of town became ran down. But there's still a pizza shop there. It's been there for 30 or 50 years. We have the north side of town. This is where all the people are moving into because of the economic growth of Pueblo. It's where the new houses are, and there's a pizza shop over there. The pizza shop on the north side of town is a much more upscale place. It charges, $15, $20 a pie. The pizza on the south side, $7 to $10 a pie. South side of town has, what do I want to say? Health citations, it's kind of dirty. North side of town, brand new, no health citations. We get an idea just talking about these competitive advantages. And as we look at those competitive advantages, we are saying one's worth more and one's worth less, but we don't have a way to draw that comparison in a lot of the data sets that we utilize. So I have a hand raised here and I'm trying to figure out how to make that work. I am going to have to practice another time. I apologize. And that hand raise thing is cool, but I don't really understand how it works. My point is that if I come up with saying, hey, here's where the industry transacts at, if I do an industry kind of market thing, we're thinking biz comps, deal stats, market comps from ValuSource, formerly the IBA data. These are the smaller databases, pizza shop would fall into that category. They're going to try to say, okay, we have all of these transactions. Here's where the marketplace is. I believe that you lay your company into that. A lot of people say that's a bad way to go because in adversarial positions, you need to have math because the math is hard to ignore. And so that's what we're going to get into here. Product. In the public company markets, it's difficult to compare prices because each company has its own strengths and weaknesses. Now, I'm going to go back a little while and say, okay, let's go back to the 60s and talk about Ford, Chevy, and Chrysler. Are those selling the same product? I don't think so. I think Ford sells trucks. They have the #1 selling truck for a long, long time. Chevy sells affordability. In other words, here's transportation at an affordable price. And Chrysler sells cool. We got all the muscle cars. We got that Dodge Dart. We got that Dodge, we got all of those cool things. Are those the same companies? And should we be comparing those two based off of their competitive advantages, their competitive disadvantages, the strengths in the market, the weaknesses in the market, and all of those. And that's really the question. Now I can expand that concept and say, okay, we have tractors out there in the public company markets. Let's say we look at John Deere or Caterpillar, and we start to say, okay, these here people produce tractors. Well, they produce diesel engines, but those diesel engines can go into trucks, they can go into tractors for farming, and they can go into construction equipment. Are those the same product or not? And the answer is I don't think so. And so I have a polling question that I would like to pop up here while I continue to talk about this. And so the reason I'm asking this question is for forewarning. I don't know, I forget, there's a literary term on it. And basically we go in and we search our databases by industry codes. And you think about that as you answer this particular polling question. Industry is typically used to represent the product. That's where I was going to go with this. And the trap with that particular item is that industry is very hard to nail down. In a small business database, you're going to see 2 or 3 word descriptions, printing company. And so when you see printing company on there, is it going to be, hey, I had a t-shirt company, screen printing, that was labeled inside of the printing companies. Who puts down that SIC code? Who puts down that NAICS code? In most of the databases that I'm aware of, that SIC code comes from 2 places. It either comes from the tax returns. This is the code that was on the tax return. And you know who does the tax returns. And so is that code that accurate, or did somebody just put it on there? And the second place it comes from is usually somebody else who's outside of the deal that says, oh, here's what they do. And so when the business forms are filled out, the business broker knows that this is what this company does because they're trying to sell it. But they take what it does, condense it into 2 or 3 things, and then somebody else looks at those 2 or 3 words and tries to put an SIC code on it. So you have to be careful about what's going on in that industry code. And yes, I believe that you can I believe that you can go out there and say, okay, let me look at this and see if it's close enough. If we have a large enough population inside of our sample size, is it really going to matter? You get all of that in place. So let me end the polling on this. I'll share the results. It's 96-4. I'm not sure, you know what I mean, if that has any meaning or not. And every valuation is unique, and in its uniqueness, you get to decide what that means. So here in Geneva, I'm with my in-laws, and he likes to watch a program about a car restoration shop. And there's shops called the Guild, and they build really expensive cars, and they build not so other cars, but they tend to be more of a, not so much a restoration thing, but they tend to be more along the lines of saying, hey, I can find these obsolete parts, or if I can't find it, I can manufacture these obsolete parts, and that's how I become a restoration shop. And so, you know, really that's what their business is. It's not necessarily that they're mechanics working on cars. And so I thought that that was very interesting. So the IRS, I got a comment here from Michael Gregory, so we'll take this comment at a pretty high value. Glad you're attending, Michael. The IRS did a study based on an extensive stats sample and found that 25 to 33% of the industry codes were incorrect. Well, there goes my, there you go. I'm going to keep that in my back pocket and see if I can't dig that out. Thank you, Michael. So I think it's very interesting that when we try to do a comparative analysis and we try to use our industry codes as a sampling of the product, it's very, very interesting to know in there. Also want to make a note about Shannon Pratt and Hallmark Cards. So it's not just small companies. I'm trying to expand this conversation and say large companies. Hallmark Cards, he went out there and he didn't use the other card companies that were available to him in the public data space. He used the he used companies like Coca-Cola. He used some other companies that sold knickknacks in locations around the company. You know, I'm not sure Cracker Barrel falls into that category, but that's the one that jumps into my head at the moment. Now, I learned from Shannon Pratt here in the past, and so if you have a chance to what do you want to say, stand up on your soapbox and sell your products, you should do that. If you're a member of NACVA, you can use the Econ Assist subscription, and inside of there you can go in and you can look at the case law, and if you look up you know, the estate of Hall, you'll be able to see the PDF file that lists all of the details of that particular case. So I'm just telling you that that's available to NACVA members. It's in the Econ Assist category. It's not necessarily part of a level or subscription, but you can get that information. It's pretty easy to get. So let me ask the next polling question. And the next polling question, oh goodness, apologize, kept that screen up far too long. Okay, is a public company operated the same way as a private company? And so now I'm trying to get after saying, if I'm comparing myself against different databases, is a large public company the same thing as a small private company? And while I'm opening that poll, I wonder if I can get to my, Q&A, because I thought somebody else came up here. I don't see anything there. Cool, cool, cool. Okay, close that. Don't see anything in chat. We are good. Okay, so let me end the polling question here and share the results. Most of the people in this particular webinar believe that a small company is operated very, very differently than a public company. I would guide you back to the Hall case, and inside of there it says, you know, it's not a legal opinion, it was just part of the reporting that was in there, that it said that Hallmark was kept a private company because they wanted to make decisions that were not based off of short-term public company standards. They wanted to make long-term strategic decisions, and based off of that, they kept the company private. And so I'm just trying to say that, you know, there's a lot of folks out there that like to keep things private. Somebody's asking how many polling questions are there going to be in this webinar. I thought there was 8 or something like that. And so, you know, I just wanted to point out that saying, you know, it's not just now. Back in 1989, when Hallmark was done, people were thinking that private companies and public companies were different. If that's the case, then when you look at a public company database, what are you going to be looking at? So size, we say that the comparisons are done off of three things: your product or your service, your size, and your geographic region. The size, revenue size, sale price, EBITDA, number of employees. Wow, that sounds like the Duff & Phelps risk premium report. But no, seriously, what constitutes size? Typically, we're going to be looking at revenue and some sort of cash flow indicator in the small databases. When you're looking up at the public companies, you're going to be looking at some sort of idea of EBITDA. Sales price is an interesting size indicator because we all know that sales prices can go up or down based off of, you know, the what do we want to call it, likability of a particular company. And so, you know, one thing I would do is I would go into the industry and probably go up the industry tree. So we're going to be looking at this plating company. The SIC code is 3471. I'd probably expand my search, if I was looking at size, back out to the 3000s and say, okay, here's 3000s. I want to see all the 3000s with, you know, my size category between 2.5 million and 3.5 million. And then I would do a statistical analysis. Now, I don't use this necessarily a strict statistical analysis that you guys might think about. I use something called the Integer Quartile, and then I lay my company in there. And I would pick that up, and yes, I would show the different ways I've sliced and diced up the information. And by showing the different ways, I can say, here's how I've seen what the market is really paying for these. And based off of that, I place my subject company in here. The problem with doing that is that people like to have a mathematical equation that they can go back to and say, look, it calculates this way. If it calculates that 2 + 2 is 4, the answer must be 4. And I'm saying, yeah, but 2 + 2 isn't 4 because one of those 2's isn't really a 2, it's really a 3.5, which means that your answer is 5.5, not 4. And that's really where we get into all of this situation. Okay, next. There we go, geography. I have not done a lot on geography. And the reason I haven't done a lot on geography is because it's hard to get my arms around this concept. I know that in all of the databases, you can go out there and you can say, okay, give me this particular region, mountain region, eastern region, give me a particular state, Colorado. Okay, based off of those ideas, you mean, does the pricing change? It makes sense to me that a company inside of Pueblo is going to garner less of a sales price than the same kind of company up in Denver. We're talking 100 miles apart, you know, and there's a lot of reasons for that, a lot of socioeconomic reasons in the state of Colorado that drive that pricing. I know that Fred Hall, again, you can use free Econ Assist to go out there and look at the articles in the valuation article database, look up Fred Hall in 2014, he put together an article and said, I'm sorry, different article, different thing. I'm getting ahead of myself. In this particular article, it's recent in the quick read, he put together an article that says basically the sales that are made in Florida have a much higher multiplier than other parts of the country. If that's the case, you have to ask yourself the decision tree. The decision tree question you need to ask yourself is, hey, is my region skewing the results? If I look at a national item, am I looking at the right results for this marketplace? Does really a company in San Diego, California that does metal plating worth the same amount of money that a metal plating company is in Denver, Colorado, worth the same amount of money that a metal plating company is in Alabama? And a lot of it has to do with not necessarily where their location is. A lot of it has to do with who their customer database is and who their supply chain is. But you get the idea. If we're going to split things up by geography, where does that wrap around? And so yes, I would probably, inside of my valuations, I would go out there and I would say, okay, let me do an analysis of geography, because that is one of the ways we split the market up. I want to know companies in Colorado or in the mountain region that do the same type of business as me. No, I don't care about the same type of business. I use the other I'm getting myself all tripped up here. I'll take a deep breath and I will launch another polling question here. And I'm going to take a quick drink of water. so the reason I ask this question here is I don't think a lot of people actually look at regions. I think a lot of people look at the national numbers. Some people may do both and say, okay, what it is. And then we're going to get into a question of saying, okay, do you keep these ideas separate or do you combine all of these? And so let me end this polling question. And the results are about half and half, about half and half. So that's a very interesting situation. One of the things I like about these webinars is that you get to ask questions inside of the polling question, you get those answers back. I know I was in a webinar on May 13, 2020, and we were talking about, how do you search this by region or by nation? And you can say it was about half and half. And so, a lot of people would be out there and you can use that particular piece of information. I think I have one person here in the chat panel. Let me let me stop sharing the results. Let me close out the panel. Okay. And Ron says the question should have had a maybe answer. And as I've said before, the reason there's so many it depends inside of the valuation world is because people don't define what's the purpose of the engagement, what are the specifics of the engagement. As soon as you start to define those, our decision tree becomes pretty clear. And yes, I think that as a general item, maybe is probably a good answer. So we're coming up here. I got another chat, so hold on. And Kent says, I search both actually, but start with national and then drill down as necessary. So here we go. In my particular decision tree, if I'm going to use a market approach, how do I start to sort that population? I'm looking for a product or service, I'm looking for a size, I'm looking for geography. There may be something unique about that particular business that I want to look at and say, okay, is there something unique here that I can overcome? And now we have to ask ourselves a question, are we going to search that particular item? And oh goodness, I'm getting a lot of comments on this particular item. So the first comment was, regional data is critical when looking at healthcare as all healthcare is local. That's an interesting comment from Richard. Thank you for that. Peter out there says, depending on where you live and how narrow you search, you may not have a statistically robust sample. And that's a true statement. That's a big true statement. So if you don't have a statistically robust sample, what are we told in our early classes? Expand your sample size. Instead of looking at a specific industry code, make it a bigger industry code. Instead of looking at a specific revenue, open up your revenue lines or whatever. So yes, having a statistically robust sample, that is that's the number one enemy of the valuation analyst is do we have a proxy for our subject company, and is that robust enough? I don't want to use the word statistically robust. I'm looking for sufficient competent evidence. Do we have sufficient competent evidence to make an opinion with? And that's how I would term that. And then Jeff out there says they are multiples. Those multiples will fit the geography of the subject business, and the adjustments of the subject will fit the specific business. I don't know what to say to that, so I just read it out loud. And Jeff, you and I can talk later on that. So I want to get down here and say, do you present each population separately or do you combine them? And the answer to that is that, when I go out here and I'm looking at, the M&A comps, and I can come over here and I start to look at the, I should call it market comps. Back in October, we changed the name of the database to market comps. So I come over here to the detailed view and I can type in, I want a SIC code of 3174 and I want, sales of 2.5 million. And I want, high of 3.5 million, and then I want everything in Colorado. And when I hit search on this, I doubt seriously I'm going to come up with anything. And the reason is because we use the Boolean OR condition. And when we start to use that Boolean OR condition, we have to look at a Venn diagram. So let me see if I can bring up my piece here. And I say, okay, over here we have SIC code 3174. I don't know if I'm fancy enough to change color. Over here, we have sales in the $2.5 to $3 million business. And over here in my Venn diagram, let me pick up blue. I'm going to say, here is my ideas of Colorado. And then we are picking up only the intersection of those. And as you pick up the Boolean and condition on only the intersection of those particular items, we mean, have you done yourself a service? Or should you analyze each of those comparative examples individually? And the question is really, what do the facts and circumstances of your case say? What is the best analysis, or what is the analysis that's going to give you the best answer? What are you going to be the most comfortable with? But I would suggest that maybe you look at all of these different values and say, maybe I don't have to combine them into one. Maybe I can look at those as, maybe I can look at those on a separate basis. Brought back to the RMA data, when you do a comparative industry financial analysis and you start to say, is this company strong or weak in the marketplace? And you can look at it and say, okay, I can't compare the company as a whole, but I can pick up individual items. The quick ratio is strong in this category. Oh, look, the debt ratio is weak in this category. Oh, look, the operating margin is strong in this category. Overall, is the company strong, or overall is the company weak? But each one of those individual ratios do not say that the company has that same characteristic. Because one ratio is very good doesn't mean that the whole company is very good. You actually have to do an analysis and combine and reconcile and synthesize those. And so I would look at each of them separately, and if I can get a statistically robust sample, I might combine them. So you have to do your own analysis there. Ultimately, what we're trying to do is search for a proxy of the business being sold because there's no direct data. And what is sufficient, relevant, competent data to do that with? And that's where we're headed to. So now we need to talk about COVID-19. And what kind of decisions are we going to make because of that? And we have to look in there and say, okay, we have three different conditions or three different states in my mind. You know, here's before COVID-19, here's in the middle of COVID-19, and then we're going to have to add on here, what do you do after the fact? Because next year, when you do evaluation and you start to look at this data, are you going to say, oh, is my small company database providing me with the multipliers that I need to use, or are those somewhat skewed? So, and here was the article I was referring to before. If I look at Fred Hall's article in BAP in April 2014, you can tell that he analyzed these companies and he said, okay, because of the Great Recession of 2008, 2009, he analyzed things for 2 to 5 years over that period after that point, and he recognized that the cash flow multipliers were down. However, the revenue multipliers had stayed the same. You know, just saying, that's an interesting finding. You can go out there inside of your Econ Assist and pull that article up if you want. But that was an interesting finding. So to me, I have some evidence that says I better take a look at this. And as I start to look at that particular item, I start to get in the ideas of saying, what timing do I need to look at? Do I need to pull multipliers from that period just after the Great Recession? Do I need to pull multipliers from the last 2 or 3 years? And now's a great time to talk about another logical fallacy. And the logical fallacy is that more recent data is better data. And the answer is I disagree with that. Just because something is newer doesn't necessarily make it better. What makes it better data is that it's more appropriate to your subject company. And if it's more appropriate to your subject company, then it's better data. So if we're looking at COVID-19, can we compare ourselves to the recession back in 2008, 2009? Should we go back to the multipliers in that period and say, this is what I want to look at? And that's kind of here during this during time. Another thing you can say is, hey, I have these multipliers out here. Do I adjust them for this particular time period? And as you start to ask yourself that question, well, how would I adjust them? Some people are applying discounts for lack of marketability. Some people are, you know, adjusting their discount rates inside the income approach. You know, in this case here, we might adjust the multiplier itself. And how much would you adjust it? I don't think you would go to the marketplace and say, oh, the stock market dropped 20%, so the value of this company dropped 20%. Would that make sense? Would you adjust all of the prices and say, hey, all these prices dropped 20%, let me recalculate the multiplier and use that one? Perhaps. I mean, it's an analysis, it's your opinion, you get to decide how you want to look at that. I do think, though, that you need to look and say, here is what happened during this period. More importantly, I'm worried about a year from now or 2 years from now. You know, I thought it was interesting that when I looked at these multipliers, when we had the tax, you know, all the taxes drop, you know, did the pricing of the companies really go up? Did the multipliers really go up? I'll let you do your own study on that. Polling question time. And here again, I'm just trying to, there we go. So here's the question is, you know, what time periods do you typically look at? I don't know if I said it out loud, but people have been taught to use the last 2 or 3 years because they don't want to be on a witness stand and have to answer the question, why didn't you use data that was newer? And, you know, I think that the answer to that question is newer data isn't necessarily better data. And, you know, this is more appropriate because it applies to the same type of economic conditions that were occurring in this industry at that point in time. Anyway, I think you do need to ask yourself the question, what time period am I going to use? And also with the ValuSource Market Comps database, that goes back 40 years. And you can actually look and see why things are going back 40 years. And you can say, okay, here's a CPA firm, used to sell at about 1 times revenue. CPA firm in the 90s, about 1 times revenue. CPA firm in the 2020s, maybe about 1 times revenue. It didn't really change that much. So would timing have any difference in that? Let me share the results with us. 62% yes, 38% no. You know, it's going to be interesting. What I do know is this, is that people are going to be looking at those different time frames. What that means is that you're going to have 2 analysis rather than 1 analysis, or you're going to have two prods of logic. And as you start to look at those different prods of logic, it's going to cost you time. As it costs you time, your efficiency is going to go down. And as you start to lose your efficiency, you're going to have to ask yourself, what am I getting paid for? And that's going to be an interesting thing. So I have a comment here. It says, over time, the anomalies with multiples for the Great Recession became irrelevant from what I saw. I have only used data for a longer period, but never for court cases. Again, the purpose of your valuation work has a huge, huge difference in this. I'll give you an example. I think this market approach idea is really great when people want just what do we want to call it? It's not a complete conclusion of value, it's a calculation of value. And a calculation of value, you can come up pretty quickly and say, hey, here's the range that it should be transacting in. You know what I mean? Is your company good or bad? If it's good, put it to the high side. If it's bad, put it to the low side. And then you give it over and people can argue over it. You know, it's a great little way to do that sort of thing. So now we need to talk about the math. And here I am an hour into this and I haven't even opened up the software, the databases to get into those and say, here's what's inside of them. Here's what you need to worry about with tips and traps. So we'll get all of our polling questions out of the way and we'll get into those. So here's the polling question as we get into the math. There we go. And I'm looking for 100% return on the bottom one, but let's talk about the math. The multipliers, I believe, are an adjustment to make size irrelevant. How do I compare a $3.5 million company to a $300,000 company, something that's 100 times smaller? And if you do that, you can take your multiplier and make that adjustment. And it's important to realize that they are an adjustment for size. If we use a regression line in our analysis and we're saying, here's the OLS, that regression line is going to give you, here's what the normal price should be for this size of company. It is a size adjustment. And I want to emphasize that, you know, they're multipliers and not multiples. A multiple is a number that can be divided by another number without a remainder. You know, so if you have 15 or 20, a multiple of that is 5 because there's no remainder out of it. A multiplier is a quantity by which you get a number is to be multiplied against it. And what we do is we take a base and we take a multiplier and we apply those two things. I realize that it's a technical difference, and I want to bring that up because it's one of the issues that I want to say about our particular market space, and that is that the better communicator you can be and the more exact of a communicator you can be, I think you'll be a better valuator at the end of the day. And by using the word multiple, I think comes from the M&A market, where they like to shorten everything. And so instead of having an extra syllable on the word, they dropped it down to multiple. But I'm making a guess there. I have no idea of the etymology of saying, here's the multiple for a business. Obviously, you know, most people use the word multiple, and it's just out there. So there's my soapbox moment. Everybody gets one if they do a webinar. Somebody said I closed the question too early. Apologize for that. I think you'll be just fine. You posted something here in the chat, and I think those chats are saved by the piece as well. If you do have a problem getting your continuing education, give me a reach out, and I'll be happy to track it down and say, no, he was there. So anyway, multipliers are size adjustments. And the other thing I want to say is that as we start to talk about this, we need to be complete with our communication. I'll give you another example. If I use the word interest, what am I talking about? And our English language forces us to choose context around the word. Am I talking about the security interest that I own? Am I talking about the interest that I pay on a loan? Am I talking about the amount of money that I'm due for giving you money? You know, I give a bank money to put in the savings account and I get 1% back. That's interest. What does interest really mean? And as we start to talk about these things, it's easy to get pulled into the wording and not necessarily into the meanings, which is where I want to go to next, I believe. So when we talk about the base of a company, we need to make sure that we talk about the size of a company. And it's not the ability to generate revenue nor the cash flow retained by the owner of that security. So a lot of times what happens is that we start to look at these databases and we say, oh, look, here I have a price to revenue multiple, I have a price to cash flow multiple, price to SDE, price to discretionary earnings, price to SDCF. BizComps used to define it that way years and years ago, whatever. It's a cash flow to the owner. And as I start to look at those things, I get confused between saying why when I use one multiplier, I get a different value than I do in another. And also what base is the most appropriate base. And so the two questions that come out of that. And so, you know, I've had a lot of phone calls of saying, which one's better? Do I use historical revenue? Do I use the normalized revenue? Do I take a weighted average of revenue? And the answer is what's the size of your company? What size company are you're doing? And you have to define what that size is by the number of revenue it is. And obviously, you know, we needed to look at the proxy of all of that and say, okay, if they had revenue last year, the last 12 months of $2 million, and that's probably the size of the company. If they had an outstanding year and they had $4 million of revenue and they don't expect it to be $4 million in the next year, you know what I mean? Would that be an appropriate size standard? I don't think so, but you have to make that choice. And so that's what you have to do at the base. And the other part of that is what I was getting at is don't confuse your population with what it represents, with the multiplier and the magnitude of the multiplier. So if you're looking at a price to revenue multiplier, what you're really saying is the size of companies inside of this population are around this particular level of revenue. And it has nothing to do with how profitable those companies are. And as I said before, we're taking an individual item out and looking at it and trying to expand it to the whole of the company. If you have revenue and there's a size of the company that's based off of revenue, and there are companies that make more money and there are companies that make less money. When I say make, I'm not talking about revenue, I'm talking about gross margin or operating margin here. So if I make 10% on my money or I make 20% on my money, the one that makes 20% is probably worth more. You know, some people would argue with me and say, no, the one that makes 10% is worth more because you can do more with it. I'm saying it's probably more likable, but anyway, we can go down that road. My point is that I'm saying when we look at the fields that are available inside of these databases, Try not to confuse the size of the company and what your multiplier represents as opposed to what those underlying fields represent. And yes, I do think you can go into these databases and say, let me take the cash flow number, here's what the discretionary earnings is, and find out what the revenue is, subtract the two, I can come up with an operating margin. And as I look at that operating margin, I can tell that some companies are more profitable. If I'm putting together a population of companies, do I want to pick companies that are very comparable to my company, and how do I do that? And so I'm trying to really make a warning out there and say, if I was in an adversarial position, if I worked for a lawyer and somebody was asking me, how do I beat up the other side? I would say in the market method, as I would look at the population and how they came up with that population, and I would say, let me make sure that the multiplier that was derived from that population really represents the subject company. Because if somebody goes out there and you know, and I know I've done this in webinars, I've said, hey, the easiest way you do this is you pick the SIC code, you drop down your 50 people, you do the analysis, look at our analyzer tool, it comes over here, you got this beautiful line, and there's what the value is of your particular item. Look at all the math behind this. The question is why did that population exist in the first place? And you have to make sure that the underlying assumptions inside of choosing those companies make sense. When you're looking at databases that have 20 or 22 fields in them, it's very difficult to determine why they are like your company. And as you look at them at an individual basis and you say, okay, here's the revenue, that's good, generates revenue, right? And if it generates revenue in the same size category as you, that's a good indicator that the price of your company should be around the price of that. But you're going to have to do that analysis to lay in your subject company in there. So let me give you, I'm not sure if I got the right slide up here or not, but I will tell you this, that, so I have kids. One of my favorite things is I'm a family man. I enjoy my kids a lot, send them off to college. Their college is a big basketball college. And so I tend to use this metaphor here. If I did a study and I say, here's the average height of kids going into college, and it was, you know, 5'8" or 5'6", doesn't matter what the number is. You would say, great. You would say the next person coming into college was going to be around 5 feet 8 inches tall. And I said, oh, but I'm in Nebraska. I was talking about University of Lincoln, University of Nebraska Lincoln, and they have the greatest volleyball team in America, women's volleyball team. What do you think if I told you that there was a scholarship player? Would you think that they were 5 feet 8, or do you think that they're going to be over 6 feet? Oh, all of a sudden the underlying data changes because our premises have changed a little bit. So let me do it this way here. What if I said, oh, not only that, but here's a male basketball player at Duke. You know, so if you get a male scholarship basketball player at Duke, do you really think that they're going to be in that 5'8" range, or do you think they're going to be over 6 feet? As you know more about the individual, the population underneath it becomes less and less important. However, you know what I mean? Having that information is good. And you also get stuck with the old, well, I don't have any better information, so I'm going to use this information. And that's something that you have to decide on your own expertise and say, as I use better information, am I getting the, am I using bad information to come up with a value, even though it's bad information? That's it. The other thing I suggest here is that the COVID warnings might be involved inside of this. So if you start to pull out a population of data and you start to analyze that population of data, however you do it, you know what I mean? What are we looking at, and did the shutdown make a difference to those particular population groups? So if you're looking at restaurants, I'm sure they're going to be hit harder than other particular companies. And as you start to value that and you look at those different sectors and those different industries that are getting hurt hard, you know what I mean? Insurance companies, I'm not sure they're going to be hit as hard. You can do a lot of insurance over the phone. You don't necessarily have to be there to sell insurance. And so they may not get hit as hard. Okay. So another thing that comes up inside of all of this, here's a personal opinion again, is the harmonic mean. So is the multiplier? Yes. Should you use the harmonic mean because it's a ratio? I'm in the unpopular group and I say, I don't think so. And my metaphor, and I'm not sure it's a good one, as I say that as I spread fertilizer on a lawn, there's a ratio. I need a pound for every 1,000 square feet. And if you're trying to figure out how much of the resource you need, in other words, how much fertilizer I need, I think the harmonic mean is good if you're trying to do a large plot of grass. However, if you're measuring how much grass you have based off of the amount of fertilizer you have, I'm not sure that you come up with the same answer. And I'm not sure that the answer is good. So what the harmonic mean does is it says for every dollar of capital I invest in this company, this is the amount of revenue I should get, this is the amount of cash flow I should get. And as we try to develop those, I'm not sure that our multiplier falls into the category of saying, here's why I would use a harmonic mean. That said, I wouldn't use the arithmetic mean either, because the arithmetic mean gets so jammed up by outliers. I use something called the Integer Quartile. What that is that you go out there and you say, let me find the 25th percentile, let me find the 75th percentile and the median. And then based off of that particular ranking, it doesn't involve magnitude, it only involves ranking. And so when you look at medians, what it does is it says, okay, you have a number down this side, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, and then you have the magnitude, 2.7, 0.66, 0.78, and that's down that side. And as you arrange those from high to low order, you cut them in half. So the magnitude of the item is no longer relevant, only the ranking is relevant. And as you start to look at that ranking, you compare the magnitude in this inner quartile and the box and whiskers plot, and you can see where the skewness happens, what your ranges are. And then, like I said, I tend to look at the competitive advantages and disadvantages of a company, and I would lay that in there. The problem with the way I do that is that it's very subjective. It's very subjective, and people don't like that. So let's go back to other statistics. We talked about regression line and how if you have an R squared number and covariance, what it's basically saying is how well that fits that particular item. It's a size adjustment, and it's not necessarily the magnitude that you're looking for. And so, histograms are out there. And as you look at histograms, you're going to see how many different buckets you have and how many transactions happen in that particular bucket, which is very useful. I mean, if you have a lot of transactions occurring in that middle area, then that means that the middle area is where most transactions occur. And so, having a value in that middle area means that it's a pretty good value. I think outliers are going to be a problem for us next year. So as we start to look at COVID-19, I think that some businesses are going to get hurt a lot worse than others, even inside of the same industry. An example of that would be, let's look at a pizza shop again. If a pizza shop has the ability to go out there and deliver pizzas, they're probably not hurt as hard as only a sit-down restaurant that has pizzas. And so because of that, you're going to see a whole bunch of different outliers and some squishing of these data points. And it's going to become a little bit hard for us to see what's going on. I think the analysis that we do on these market approaches in the future is going to be very tenuous, if you will. Something else that I've seen happening, especially in the public company marketplace, is that people will apply to the unadjusted subject company, and then they'll make adjustments after the fact and show how that particular decrease occurs. And I guess I should explain that a little bit more. It's saying, okay, we had cash flows from this company. Let's apply our multiplier against that. In other words, I'm not going to use the sizing of my particular company here in the recent quarter. I'm going to use my company in the recent past. And then as I apply my thing on there, I will take into account what happened in that first quarter and adjust the whole down. It's something that people tend to do. You also have that question that came up in the comments before, and that part in the comments was, hey, is this a fire sale? So as we look at the public markets and how much they sold off, can I use that adjustment in my discounts for lack of marketability? Perhaps, but is that a fire sale or is that in the normal course of business? And we've seen the market come up since then. So did not know this, but I intended one of the COVID-19 things, and in India, the end of year date is March 31st. Can you imagine doing valuations at March 31st? What a horrible date to do a valuation at this year. Of course, it's better than not doing a valuation at all. So at this point here, I have about 30, 40 minutes left. I'm going to try to jump into these different databases, kind of demonstrate them. As I demonstrate them, we will see what happens with the tips and traps and what's going on in percentage in this. So the first one I kind of want to talk about is the ValuSource Market Comps, formerly the IBA data. We are working to improve this data, as you know and have heard. A lot of times when you try to do an analysis with the population inside of here, you see some, let me use the word interesting results, and you have to adjust for those. We are trying to go in there, clean that data up, try to clean up the definitions and make sure that we can explain everything. Have not had a good time with that. I know that Deal Stats had just completed that particular process. You know, when they renamed their from Pratt Stats to Deal Stats, they had gone in and done a lot of that as well. BizComps, I'm not sure what Jack is doing with his data set. BizComps is kind of interesting. I'm seeing the number of transactions kind of decrease in that instead of increase. And so I'm a little nervous about that particular data set. I will say that in the ValuSource Market Comps, about 80% of the businesses have less than $1 million in revenue. It really is targeting the very small company. And so when we look at our particular company and we're saying, okay, if I have a data point for, you know, $3 million in revenue, what does that really do for me? And I want to talk about the different ways to search it. So we typically have a last 10 years of data and all data on here. And this goes back to address that problem of saying, okay, what is the correct time frame to look at for my subject company? Do I want to look at what's currently going on? Do I want to look at what's going on in the past? And how do I ensure that I'm looking at the same economic conditions as my company? And then we have a quick search here, and the difference between the quick search or the standard search and the detailed search goes back to that question I was talking about before and saying, okay, do you combine all of these things? Do you say, I only want to look at companies with this amount of revenue, I only want to look at companies in this particular area and have this particular SIC code? So let me come over here and say, you know, let me look and say I want to look at companies in Colorado. So I can look at companies in Colorado and I can say, okay, let me look at companies for the last, you know, 3 years. So let me put in 1231-2017. If I don't put in an end date, it will give me that. So I can search and I don't have any data to look at here. So maybe I pull off of this parameter and I go back 10 years and I say search. And now I can see all of these different companies inside of, hold on a second. I don't know if I have a Q&A here or not. Let me pull this down. Okay. And so now I have a whole bunch of companies here. I have 78 companies inside of my population, but they're all over the board, you know, 1522, 1761. And I will tell you, one of the weaknesses of the IBA data is that it's hard to get out more than 6 SIC codes. So if I wanted to get out, you know, special SIC codes, I could say, okay, let me type in over here, you know, 2721, put a space in and do 2752. And then when I press search, I'm going to get those 2 items, and I can go up to 6 SIC codes. That's one of the things we're taking a look at. We're trying to say, okay, if I really want to see what sales in Colorado were, then I can go out there and pull that down for Colorado and not have to worry about this limitation of SIC codes. As I said, you can come over here and look at the different size characteristics for sales, revenues basically. Do I want to look at cash flows? Do I want to look at the price of the deal? I can look at that. And pull that information in. When I get there, I'm going to be able to pull down data, analysis, or direct market data. As I pull down any of these items, there are spreadsheets and they are spreadsheet tools. And so when I open up my spreadsheet tool here, it is a macro workbook. And now we get into that question that we had at the front. Is this a black box, or is this something that you can, you know, is it transparent enough that I can recalculate it? I have a question out here that says, can you look at the first 2 or first 3 digits of an SIC code? The answer is not at this time. as I said, I like to search and say, hey, give me 3XX. You know what I mean? I don't care about the last 3 digits of the code. I just want the first digit of the code. And the answer is no, I cannot do that at this point in time. That said, you know, you can scroll through a lot of those codes. Let me click back. You know, the problem we have as evaluators is we always have to go back and, you know, so if I click on clear here, I can say clear all of this. Let me go back to my standard search and get the last 10 years of data. Hit search and it will populate everything. So now I can go down my side. I can sort any of these fields. So if I want to see what the highest revenues are, low to high, here's my sales. You know, I have somebody out here with negative sales. Don't ask me how you get negative sales. That's part of the problem. You know what I mean? And here's somebody that has 0 sales, 0 discretionary earnings, 0 multiples, but there was a transaction for general dentistry in 2017. We need to clean all of that stuff up. But you can go through here and say, okay, you know, in the 8,000s, you can come through and pick up what those are. Got another question out here that says, how do the IBA transactions handle inventory? Great question. Also have a question here afterwards. How many new transactions are added to the IBA database in 2019? So let me handle the inventory question. So when you look at these very small companies, and I don't care what database you're looking at, those transactions are being brought in usually by a business broker or an intermediary. And as they fill out their transactions, they tend to look at this and say, okay, what's going on here? And so the idea that you have to say is, okay, what's the value of the inventory in there? And as you look at that value of inventory, you have to worry about the market. You know, what I'm trying to say is you don't have a lot of information about that inventory other than it's a number. And so let's look at a couple of different kinds of businesses. So if I'm transacting a business, say a plumber's truck, I'm a plumber and I go around and I fix, you know, toilets for people in the neighborhood. I have parts and inventory on my truck. Those parts and inventory are going to be included in the sales price because I'm going to give over all of that to the new owner. They're not going to have to go out and buy that. However, if I'm a liquor store owner and I start to look at that liquor store item and the inventory in there, I'm not going to pay a business broker a 10% fee or a 5% fee to sell that inventory just because it sold the business. I'm going to sell that at regular price. And so that inventory is usually excluded from the price. And so the problem we have with most of these databases is that we get great definitions, but when you start to look at the data underlying those definitions, you have to ask yourself, is it real or not? And as you start to analyze all of the databases, you know, the market comps, the deal stats, the biz comps, and you start to look at all of those, you start to see there's some wavering inside there. And the simple reason is because people, while they're trying to follow their hearts and fill out the forms correctly, you know what I mean? They're just doing it for one transaction. They're not looking at it as a group, and they can pull things out. So what I'm going to suggest to you is that as you look at inventory inside of the IBA data, and you start to look at those different transactions, and you look at your population, you say, should I include this? Should I exclude this? It's going to depend a lot on the facts and circumstances. What's the industry? What's the product that you're selling? Would the inventory normally have a value outside of this? And if it doesn't, I seriously doubt you're going to change your sales prices very much because of the inventory included in there. Look at your subject company and say, is there a huge amount of inventory? And would this inventory transfer over to a new owner? And if the answer is no, then, you know, you probably need to make an adjustment for it and worry about it. What I'm trying to say is that I think we get all caught up sometimes in the definitions and we get less caught up in the actual practicality of the matter. And so that's how I would address the inventory inside of here. Hopefully when we clean up this database, we're going to have a nice little white paper on how all of this works. We'll have some studies that show exactly that. Roughly how many new transactions were added to the IBA database in 2019? I'm going to say a lot. The problem is that when we append, and I use that word specifically, when we take the transactions and we put the new transactions inside of here, when we append those particular transactions, they're not just because they're the last 2 months of the year. So, you know, if we added 2,000 transactions last year, some of those could come from what do I want to say, 2017, 2018, 2012, 2014, Mark has reached out to a business broker that didn't know we existed and said, oh, hey, I like to get paid a little bit for those, plus access to the data set. Yeah, I'll be happy to give you my transactions for the last 10 years. And so they laid themselves in there. What I can say is that if you start to look at our total number, let me come over here and get rid of this, all data. And when I search, let me pull my screen over here and search on all of this. You can tell that there's 46,000 records. I know that just a few years ago, that was down around 40,000, 41,000. So you know that we're adding a ton of new transactions inside of here. And so that's good. Again, it's not necessarily how many transactions you add, it's the quality of those transactions. And so, when I showed you that sign and said, oh, here's a transaction that had, no numbers for revenue, no numbers for discretionary earnings, no multipliers, it's a worthless transaction, but it increased that record count by 1. And so you have to worry about that. Thanks for those questions. I got lost in my head as to where we are with this particular item. So I'm saying you can only get 6 out. If you want to look at the different codes, you can pull out those codes themselves. You can also use, you can sort over here by sales and say, okay, if I'm looking at sales, let me pull out, I can trying to say, hey, I can look at the date of sales over here. So the last sale date was October of 19. I can pull those out by that date and sort it, and I can see what's going on. You have a problem, and that is what records do you want to keep and which records do you want to get rid of? So if I sort by sales over here, I go from low to high, and this here is the whole entire data set. There's a lot of items out here without a revenue number, but there is an item out here with the discretionary earnings number. Some people are going to say, oh, I can't use that particular record because why? I don't have enough data for it. All the data points aren't in there. I don't think it has any credibility. Then again, if you look at that particular item and you say, hey, somebody has said, they signed a piece of paper saying this is a sale that occurred. They had discretionary earnings of this, they had a selling price of this, and I have a multiplier. Would that, is that good enough? And it depends on the sufficiency and the competency of the evidence you want to use and how far you want to drill down that tree in your own mind. Not only in your own mind, but the people who read your report also have to agree that your decisions on that were good. And so I'm not saying that you shouldn't use that. I'm not saying you should. If you start to look at the law of large numbers, that probably is, okay, it's a large number. And then another question here is, how is discretionary earnings calculated? And that is a great question because that's going to lead me into something I wanted to show everybody anyway. If I come over here to the help button and I look at the database fields in theory, I come over here and I go down to my ValuSource Market Comps because programmers put things in alphabetical order. That's how that looks. So let's look at the field definitions. We'll come over here to summary and discretionary earnings. So discretionary earnings is annual earnings before owner's compensation, interest expense, and income tax expense. What about depreciation and amortization? The question is that, technically depreciation should equal the outgo of capital expenditures. In these very small businesses, that tends to be the tendency. And so if we're looking at that particular item, that's why it's not in there. I would also tend to say that if you look at that and you compare it to the other databases where they say depreciation is part of that number, in other words, they remove depreciation and actually try to get it to more of a cash flow number, I think you're going to find that the counts are pretty likely. This is one of the areas that we have to come in and clean up and explain and make sure that you can explain it in your reports. And it's always been a real bastard in the past. I believe that I had another question pop up here. If I have biz comps and deal stats, why should I add this database? I don't think you should. How does that sound coming from the guy who does this? The reason that this database works, it goes back to the cost of doing business on your side of things. And that is that I have to buy data out there. Back in the early 2000s, I would tell people you would have to spend $5,000 or $6,000 to get into this business. In other words, you have to buy all these databases. And as you buy all of these databases, you start to accumulate the cost up to around $5,000 or $6,000. That has dropped dramatically. And we have subscription products out there. So now you can say, oh, let me have a few pulls from the market comps database, a full pulls from the public company database. And what is sufficient competent evidence in your mind? And as you start to pull in those particular items and you say, okay, how can I get this for the best price? I don't even know what deal stats cost. I don't know what biz comps cost, but I know that for about 200, let's say about $500, you can pull 3 or 4 times from our market comps and from our other ones. Do I think I'm going to get better information because I go to deal stats and not market comps? I think you'd have a hard time with that argument. I think that, biz comps, deal stats, market comps, they all go to the same number. Some look prettier, some are easier to use. I'll give deal stats that they have a better interface and it looks prettier. Do I think the data itself is a lot better than this data? Probably not. And so I'm going to say, what is the world you deal in? And as you start to say, wait a minute, I'm a practitioner that deals with 3 or 4 valuations in a year. I don't want to lose those clients over to a big firm, so I do that particular work. If that's the case, you know what I mean, and you're doing it for tax purposes, is it going to make a huge difference that you have one database over another? I'm kind of thinking not. Let's say that you do big IRS cases, you're probably not going to use biz comps or the low end of deal stats. Deal stats also has high end companies in there, and you're not going to use the low end of deal stats because those companies are, upwards of 15, 20, 40, $50 million. And so, you have to ask yourself, why would you use that database anyway? And so when we start talking about these things, you really have to take a strategic look. And I'm doing a webinar on this tomorrow. I'm not sure how good it's going to be, but I'm doing a webinar on it saying, what's your efficiency rate? How much money do you really have to pay to do these things? And if you already own biz comps and deal stats, I hope you're a litigator, because a litigator might want to go into court saying, look, I've searched all 3 of these databases and here's what it's told me. You know what I mean? On the other hand, maybe you're a litigator and you say, I use this database. I have deal stats. I use deal stats. So I use that one and I didn't pay attention to the other 2 because it has the same information. It's redundant and it's wasteful of time and money. Those are questions you have to ask yourself, but it's a great question. I think you want to use market comps, M&A comps, and public company data because it's inside of a package that's very reasonably priced and you can get after it and get your work done very quickly. I have some other things coming up here. I've obviously opened up a box of worms, so let me go after that. Do brokers get paid for submissions? The answer is in biz comps, they don't get paid for submissions, but what they get is they get access to the database. So business brokers want to use this data kind of like an MLS. And so they say, okay, here's businesses in this industry, a transaction, this range. And so I can talk to my client or future client, my prospect, if you will, for this. And they get access to the database, and that's why they tend to do that. Jack was also a business intermediary. Jack Sanders put together this database because he needed that information, and that's why it's in place. And so he doesn't do that. I'm not sure what Deal Stats does. I know they exist. I know they're a good company. I would not be afraid to use their data at all. M&A comps. The brokers get credit for products. So in other words, if you're a broker and you sell, 10 businesses last year, you can get quote unquote paid for those. I don't think you're going to get a check, but you do get credit for other products as well as access to the database and some of the other products that we use for business brokers. So the answer is yes, there's always some sort of, in my mind, there's always some sort of compensation, some sort of personal interest for those brokers to submit those things. It's not like they're doing it out of the goodness of their heart. Let's face it, it takes time and effort to put together these to put together these submissions and get them into the database. Another question. So to be clear, do you add inventory to your multiplied results as with BizComps, or is inventory implicit and the multiple as in deal stats? He had to step away for a minute. And the answer is it would depend on the industry And depending on that industry, let's say it's a liquor store, I'm going to have to be very careful with my population. I'm going to look at those and say, is the inventory included in the liquor store value or not? If it is, I might make an adjustment, can recalculate my multiples and put it in place. And as I recalculate them, I'll adjust accordingly. Obviously, if we're going from an equity value to a, what's the word? I want to say enterprise value, but it's not really that. It's more like an operating asset, less operating liability value. You know, that's what most business brokers are transacting at, you know, and so when you look at those particular items, you have to add back to get to an equity value, which is one of those adjustments we make. And as we make adjustments, you know what I mean, the further away we get from our subject company to the data that's at hand. Okay, got to go back. I had some more questions in the question panel. Again, these are my opinions. I love talking about this stuff. I'd be happy to talk to you more about these, you know, and so reach out to me. If you disagree with me, so be it. There's a lot of people out there that do practice at a different level, a different scale, and they say, nope, this is the only way I could do it, and go for it. It's your practice. You're the one that has to stand behind the report. Your name's on it, not mine. Comment on seller's discretionary earnings. If there are 3 owners in one company with the same size as in another exact same company with only one owner, the SDE is totally different, not apples to apples. And here's where I say you have to think back on that. Are 3 owners really pulling out 3 owners' salaries, or are they working the business and are employees? And the question is, you know, I always go back, Chris Mercer's a great mentor out there. He doesn't know me from Adam, but he's a great mentor. And he tells everybody, find the cash flows that go to the security. Maybe it's Chris Treharn that says that. Chris Treharn is the one that says, find the penny that goes into the owner's pocket. That's the penny you want to count. So if there's 3 owners in one company, are they really 3 owners or are they 3 employees? You know, as I say, I like to watch people watch TV, and some of the greatest examples out there are Gordon Ramsay goes around to those restaurants and hotels and says, here's what's wrong. You know, you got 3 owners. Well, are all 3 owners working it, or, you know, is one owner working it and the other ones are getting paid? So you got to be careful with that. I think excluding that data, if you can get there, is a good way to do it. Keep in mind that your operating margin, which is really what we're talking about here, is different. So if you were looking at a company that had 3 owners, that operating margin is going to be hugely different. And as you start to look at those particular operating margins, maybe you want to do a different kind of comparison inside of the thing. The sizing category inside of discretionary earnings is just a size. And it says, here's what a typical size on discretionary earnings would be. And so we're getting confused in the context here. Great comment on SDE. Another question or comment. You might want to point out that IBA's discretionary earnings is EBIT plus owner's comp plus perks, and BizComp's and deal stats is EBITDA plus owner's comp and perks, which is the difference of depreciation and amortization. Maybe I missed that, but that's exactly true. What do you do with that depreciation and amortization inside of there? In addition to adjustments for the liquor store inventory, how do you look at adjustments for other assets, such as accounts receivable, real estate assets? So here's the thing, is that typically in evaluation, and this is what I do on other webinars, is we say you're usually going to value an equity value. And if you're valuing an equity value, here's my percentage of partnership, here's the shares of stock that I own. You have to bring everything back into an equity value. What transfers in the sales price is really important. You need to look at the questions and figure out what transfers in the sales price. Does accounts receivable transfers in the sales price? And we're talking about really super small businesses here. You know, hey, we got $750,000 in revenue. How much, you know what I mean, do you really think is somebody going to sell that business and say, here's my 10 shares of stock. This is a stock sale. And you know, probably not. So now we got to make an adjustment and say, okay, if we have accounts receivable on the subject company, do we need to lift that pricing up a little bit? And the answer is yes. You need to lift it up for the market value of accounts receivable. But that's if you're going after the equity price of the company. And so make sure you understand what you're valuing. Is it the operating assets minus the operating liabilities? Is it the, you know, equity of the company? Here's the value of a share of stock, or you know, is it something in between? MVIC, we can get in there and say, here's the market value of invested capital. We're going to take debt out of this. And you know, we could have a long conversation about WACC and how that works. Another question, what size company would you stop using SDE and focus instead on net income or cash flows? More of a return on investment. Well, that's the whole point. And the whole point of this whole thing is saying, okay, those multipliers out there, here's the revenue of a company, here's the SDE of a company. Those are based off of size. That's a sizing adjustment. It's not an operating margin adjustment. And so if you want to deal with an operating margin, then deal with the operating margin. Calculate all the values inside of the databases and say, here's what the operating margin is, and do it off of that. And so when I start to look and say, okay, here's SDE, it's not that I'm looking at what size cash flow does things change on. It's what's the size of the company and how am I accounting for the size of the company? You know, we can go up to big companies and say in the public guideline database, you can say, here's EBITDA. That's a cash flow proxy, if you will. And as you look at EBITDA, you know what I mean? Saying, okay, that's a sizing issue. It's not necessarily the profitability issue. And those are two different things. And the last part of that comment is since SDE is buying a job, yes, most of the companies inside of the market comps is people trying to get underneath, I'm saying that the wrong way. They were under the thumb of somebody yelling at them, and now they're not under the thumb of somebody yelling at them. Instead of having one boss, they now have all of those customers. And so it's an interesting quest, if you will. But I think it's interesting. The super micro business piece of this is just incredible because there's a lot of things going on in the super small companies that we've never really done. You know, we were talking about having 3 owners inside of here. Again, I'm just going to promote something else and say, you know, one of the applications in that Econ Assist is a compensation database. And you might be able to go into that compensation database and say, oh, here's somebody who handles the front end of a restaurant. I don't know what they're called. Or here's somebody who handles the accounting of the business and figure out what their values are and make your adjustments there. So I'm totally lost. I think I'm over here and trying to say, okay, here is our worksheet. And as you look at our worksheet, you can say, okay, here's the selected transactions. Let me delete the note on here. And you can say, okay, I have my price to sales. It's in a particular order. If I come over here to my tools button, this is nice. I can sort my transactions. I can say, okay, sort by my price to sales. And I want that in an ascending order. I'm having a hard time using my mouse here. And then I right click on the button down here. It will sort that automatically for me. Sort completed. Tools area helps you do things with macros. Now when I have that, I'm just going to figure out what my whisker plot is, so to speak. I'll type in the median of that particular range. And I'll type in my percentile. Again, this is based off of ranking, not, yeah, I need a comma, not the magnitude of the value. And so when I put that in there, I get that, and then I can copy that down and say, okay, here's my 75th percentile. So, got to change that to 75. So what I get out of this is that most companies are going to transfer between 64 cents and $1. That's a 40-cent differential. That's pretty big, pretty big. But as I look at my subject company, I'm going to say, okay, based off of that, do I fit more towards the high end or more towards the low end? And then, of course, the low number here is 0.44. That's where my tail would go. And the high number here is 1.41. That's my high number. And then I can take the difference between these two. And I come up with 36 cents. And if I type in 1.5 times that 36, I can find out what my outliers are. I would look at Integer Quartile out there on the internet. And like I say, you can create a chart out of that and you get a nice little box. Let me open up my annotate. And so the whisker plot looks like this. You know, your point down here is 1.41. Your point here is 0.44. Get a box, it looks like this. and that's your median, and that's your 25th. So that's 63, that's 83, and that's 99. That's not how anybody I know teaches it, but that's how I look at this. That's what my opinion is and how I put that in. Then I'll create one of those for all of the different elements that I'm looking at. Let's say I want to look at Colorado. Let's say I want to look at the industry as a whole. I might even use the whole database. Say, here's all of IBA put together. Here's all of the transactions inside of there. You know, I might do it according to size and say, here's all the transactions less than $1 million, but more than $2 million, and I can put that in there. Anyway, let's see if I come up with some more questions here. That percentile ranking is almost meaningless because your sample size is so small. Interesting comment. I agree. So the question is, you know, when you only have 10 items inside of here, is it worthwhile to look at? Should I just take the median and say, hey, you know, most of these transactions are from here? You know, if you use such a small sample size and you cut this up, what we're really saying is that, you know, between 63 and 99 cents, so there's 1, 2, 3, 4, there should be about 5 transactions that are represented in that. Is that enough? Is that competent? I'm sorry, is that sufficient evidence for me to say the transaction should transact in this area? I'm not here to make that judgment call, and I'm not going to tell you what that judgment call is. If I could do cookie cutter work like that, you know what I mean, you guys would be out of business, because I'd make sure ValuSource put together a program that could do that. But we don't have that kind of artificial intelligence. You know, obviously, if you had 100 transactions inside of here, you're going to get more confidence in the number. I don't think that these numbers are bad, but I think that how much confidence do I have in this number? You know, you have to look at your company. You have to look at this particular item and say, is this real or not real? And if it's real and you have a lot of confidence in it, then you go with it. We moved pretty quickly through that conversation. Okay. The other thing that these analyzer tools will do for you is that they actually will help you analyze things and give you a better sense. So as I move through this, you can see that there's a sheet here. You can get high, low, median, harmonic means. All of that's calculated. And that was a great question, by the way. How many items do you need to have in the sample to have it valid? I've said many times before, it's the confidence you have in the number, not necessarily the number in the sample size. As soon as you put a different question on it, you get a much different answer. And saying, you know, what was the answer before you had any observations? And the answer was, well, I don't know. It's probably going to be between 2 and 6. You know what I mean? Times discretionary earnings, or, you know, somewhere between 1.5 and 0.5 revenue. So you got that narrowed down a little bit. So I think that's pretty good. So, you know, Ron out there says that Ray Miles, he's one who founded the IBA data, said that 5 or 6 transactions would be sufficient. Again, I go after it and say, how much confidence do you have out there? Having 1 or 2 transactions could be very, very sufficient. You know what I mean? If they're exactly like your company. I mean, let's say I had the population of my company had a transaction 3 months ago, real transaction, you know, arm's length. Yeah. So Daryl out here says, in an R-squared calculation, a correction coefficient approximating 0.67 with only 7 observations is generally statistically significant. You know, so, you know, thanks, Daryl, for bringing that up. That's kind of cool. So here's what I say. I say that the first skill you should learn as a valuation professional is communication skills, because you have to explain what you did in great detail at a very fine, granular level. And the second one you should get into is statistics and understand where the statistics are coming from and what they mean. So yeah, that's cool. And this is always where the conversation goes at this point, is what's statistically and significant. So there was a question out here that says, years ago, we start collecting data in here for like 3 years prior to the sale. And the answer is that, yes, we have tried to collect that data. Let me come back to my data set and come over here to the details. If I look, getting myself corrupted here. If I look at this particular, let's see, I'm trying to find something with a lot of numbers in it, and I'm not having a good time. Okay, so here is a company, and I look at details. As I come out here, we have this EBT, which is basically your discretionary earnings, and then we have year two. So I1 is for year one, I2 is for year two, I3 is for year three. And yes, we do try to collect that information. The problem is that we haven't been able to get that from the brokers. And that is one of those things they're saying, hey, what do I get for submitting this? And is there enough of a self-interest for me to submit more? And that's one of the questions that we've always had a hard time struggling with. And I'm just being honest with you and saying we're trying to get that accomplished. Okay. So I have about 5 minutes left and I haven't even touched my other databases. I hope it's interesting. So the M&A database, let me tell you about the tips and traps of the M&A database. This is driven, we've got a partnership powered by Tagnify. So the M&A database is a public to private database, or private to public. Basically, public information is utilized to fill this database out. A company announces an acquisition, they capture that information, Tagnify, we pull that into this database. One of the things I like about this particular database is that they're not making any distinction over any of the data. So there's data out here that said, hey, this deal occurred. And now we're back to a histogram. The histogram is telling you how many times a deal can occur, which means that your business is marketable. And that's an incredible item when you're trying to come up with a value, saying, hey, can I even sell this thing? And the answer is yes. So somebody says, have I asked question 8? I think I've asked all of the polling questions at this point in time. Let me double check. But as I recall, I don't have any more to offer. Let me drop this. Yeah, I've asked my 8 questions. Kind of crazy. So in the M&A database, we are taking public company records, scraping them, putting them together with other information that's involved here, and you can sort this. So what I want to make sure that you understand the details are is that because there's so much information inside of here, 10,000 records overall, and it only goes back 10 years. We did some comparison against the done deals data set, and we said, okay, how about this kind of company here between, was it 5 million and 15 million, or between 10 million and 20 million, somewhere in that range where a lot of deals occur, you know what I mean? And you know, the numbers were significantly lower. And then I started to look at the data and I realized that done deals goes back to 1998. Here again, we only have data going back for about 10 years inside of this data set. So you're not going to get that reach back that you have in the done deals data set. You're going to have to ask yourself, do I have the logical fallacy of recency under my belt? And if I don't have to worry about that, recent data is better, I can use this. But I do suggest that you take a look at this detailed area, and you can get out here and see what those different values are. Again, they're private to public databases, so all of those records are available. I'm not sure that you can get to them from our database, but if you go out and use your amazing skills as a researcher, you can pull out that information from Edgar and SEC. That's what I like about this, is that it tells you what those particular items are. The traps inside of here is that you really have to pay attention to what's being presented to you. So, you're not going to get a value for everything, enterprise value to revenue, equity value to net income. Make sure that you're seeing exactly what those numbers are, and you see the details on what those definitions are, so that you can make the appropriate adjustments to get to an equity value on your side. Again, you know what I mean? I tend to look at it and say, let me give all of the population and say, oh, here's all these numbers. They don't mean anything. Let me break it down and say, here's the numbers with value. And then I can even break it down more and say what is common to me. Let me come over to the public company database. Guideline Public Company database has a couple of things going on with it. The first is that, again, it's powered by Tagnify data. If you do a lot of work, I suggest you go out and look at Tagnify. They have packages that are much more expensive. As I said, the reason that you want to graft, or I'm saying this the wrong way, the reason you want to drill down onto key value data is because of the incredible value. So as you start to look at the different subscription levels, and I'm not trying to get anybody to buy anything here, but it's the value inside of there. Doing 3 or 4 of these, you can buy a lower subscription level. Doing a bigger value, you can get up higher and get access to a whole bunch of different databases, for a low low price. As you start to buy some of those other data sets on their own, you start to increase the amount of money it takes you to be in this business. And the question you need to ask yourself is what is the sufficient, competent evidence that I need to include in the typical report that I do? Public company search, very easy to do. Put in your NAICS code, zip code, or a description. Our descriptions come up over here on the side. As I hover over it, I can see what this particular company is doing. I'm of the opinion that most of the valuators I deal with are not dealing in this market space. And so having a public company is just a matter of procedure. Hey, I looked out here for companies in my particular range. They didn't have it. As I scroll down here, I was hoping to find some, there's one. So I have an item out here where I don't have a ticker symbol. That means that I have data, but the data is from a different date. And it's no longer traded, or it was acquired by another company. So I have information on GAN Limited, but I don't have a ticker symbol because it's not actively traded at this point in time. If I come over to the detailed tab, I can type in a ticker symbol and get those. As I select records over here in the checkboxes, it comes over to my selected records. That's what shows up. I have two outputs. I have a fundamentals output, which gives me the balance sheet, income statement, cash flows. Also, you can get the industry ratios, or I can get the multiples. The multiples are the price the share was trading at on that closing day. Closing day is the valuation date, and cutoff date is when those reports were submitted to the SEC. So a lot of times you'll put in a closing date of say 3-30 or 3-1. You want to get stuff that was submitted to the SEC by a couple months. We get into the known and knowable standard. And as we look at those known and knowable standards, we get there. The valuation date is the valuation date, you're going to get your pricing for those companies. And as you look at your multiples, you're going to say, oh, this here particular company was, priced at such and such a share on that particular day. There's two models you can look at inside of there. I think in some of our databases, our subscription levels, you only get a certain number of downloads. At the beginning, I said, here's my email address, dmiles@valusource.com. I'm easy to find, reach back to me. I'll be happy to either drill out some of these data sets and say, hey, here's what you can see and here's what we offer, or give you some extra downloads so that you can play with it a little bit. I know that gaining knowledge sometimes is actually in its use, and so I would be happy to do that for you. I have run out of time. I want to say thank you so much for joining me this afternoon. I hope that you have learned something. I hope that, not so much learned something, but I hope you've had the questions that you know to ask yourself and say, how can I improve my decision tree process? As I'm looking at a market comparability chart, am I comparing the right things? Or am I just going through the motions? Am I just picking up an industry and saying, here's the industry I'm putting into place and doing an analysis, here's my object of least, or here's my OLS regression line, and so here's the value based off of the calculation. My R-squared number's 75, that's good enough, and so I'm just going to say that's the value here, without putting the thought process into actually what you're trying to accomplish. And that's what I was hoping you would be able to do with some of those decision trees. I'm sorry, I wish I had more time to go through these databases and say, here's what some of the tips and traps are. I will try to clean this presentation up a lot in the future, and as I clean that presentation up, maybe we'll do some stuff. So anyway, I just want to say thank you so much. Hopefully we also did a little bit about having interaction. These Zoom webinars and being stuck behind our office doors is kind of bad for us. I miss all of the networking capabilities, and so hopefully we can work more too on being able to interact on Zoom, and you do that through polling questions, and you do that through chat. And I got to figure out that hands up thing, because I think having people be able to come out and say, hey, I'm in the room, how do I do this particular thing, or this is how I do it, I think you're totally foolish. Okay, I'm foolish. I have a great gig, so I don't have to be right. I just have to do my stuff. Have a great day. Stay safe, stay sane. Thank you so much.